Explanations of multiple choice questions based on marginal costing and cost volume profit analysis from Cambridge past papers. Let's start with a specimen paper 1, question 27. An accountant prepared the following break-even graph. Remember that the break-even graph is designed to illustrate your fixed costs, which will always stay the same unless obviously they're stepped, and then you would literally see a step in it. Your variable costs, which are then the difference between your total costs and your fixed costs, and will obviously increase the more you make. And then it also plots your sales revenue, which shows how much you would receive for every unit that you sell. And obviously this would be 0 when you sell nothing, and you would times your quantity by your price to get your total sales revenue at any point. The question asks or says to you that the budgeted sales volume is 4.5 million units. In other words, this dotted line over here shows what the budget is, what they are wanting to actually sell. What profit can be anticipated at this level? In order to read off the profit, what you need to do is realize that obviously the profit must be this little gap over here between the sales revenue and the total costs. So you can either work out for yourself how much each block represents and then just count it down. That would work. Or you can read it off sideways. What is the point of sales revenue? What is the point of total costs at that point? And then figure out the difference. So what I've done over here is I've shown you that the dotted line is what you're busy looking at. I read profit as $8.5. You can see it's nicely in between the $8 and the $10 million. And then I read the total costs off over here as $6.25 million. Now, reading off in between here, it's not always as easy as you might think. So sometimes you might find that your answer is a little bit out. So in this case, for example, I get an answer of $2.25 million, but if you look at the options given to you, the closest is $2.5 million. And so the option that you would choose is going to be A. Sorry, it should be 2.5 here. So that is the option that you are going to choose. It would obviously seem that I misread it, and or the diagram is slightly off, because in fact I would argue that it goes through 6 at exactly the point of 4.4, I would say. But anyway, so you choose the closest option, which in this case would be A. Number 28. Which statement best describes job costing? Now remember, the job costing means that you are costing each individual job. It's usually used in a situation where each job or each product is very different to the next one. So it might be that you are custom making particular orders or something like that. So if you have a look at the options available, A specifies a costing method that calculates the cost of meeting a specific custom order. That one certainly does seem to apply to job costing, but we need to just check the others before we choose that as the answer. B, a costing method that calculates the cost of producing a number of identical units for a customer. That is referring to batch costing, which would again be used in batch production, etc., where you're making a number of different units that are all the same, but that batch is for a particular customer, and each batch might be different. Number C, a costing method that enables overheads to be absorbed into the cost of the product. This is an explanation of absorption costing, and so that's not going to be our answer. And lastly, a costing method that separates fixed costs from variable costs is actually a description of marginal costing. So, as we saw at the beginning, we would want to choose A as the answer. Let's now look at Cambridge, March 2016, paper 1-2, question 27. Which items are included in the marginal cost of a unit of production? Well, for this one over here, your marginal costs, remember, are your variable costs. So you want to keep in mind that your direct labor and your direct materials, in other words, your prime costs, are in all these options here. So if you look at these, D is saying it's only direct labor and direct materials. All the others are showing your direct labor and direct materials plus something else. So you need to realize that obviously those would be in your marginal costs. They are by definition variable because they are direct. And then have a look and see if there's anything else that you would want to include in there as well. Number A includes fixed production costs and variable production overheads. Now, anything that is fixed will obviously not be a variable cost by definition, which means that we are not going to want to choose A, even though variable production overheads would be included because of the variable over here. A can't be an option because of the fixed. Number B, likewise, is suggesting that you would use all your fixed costs, in other words, your fixed production costs, as well as any fixed marketing and selling and admin costs. But again, because it's fixed, we wouldn't be using it in marginal costing. So therefore, B also is not an option. Number C, variable production and overheads, in addition to the direct labor and direct materials, as we discussed for A, is an option that we can choose, and there's nothing that we disagree with. So C is certainly an option. And then D, where it's just got the direct labor and direct materials only, we're not going to use that because we do want to keep our variable costs, our variable overhead costs also. So therefore, C is the most suitable answer. Let's now look at question 28. Which statements about cost volume profit analysis are correct? Number 1, profits are calculated on an absorption costing basis. Well, before we start, let's remember that cost volume profit analysis is basically where we are doing our break-even calculations, which can also include our marginal costing. And over here, we're trying to figure out what are our production levels, our costs, etc., using a break-even graph or break-even calculations. If we're talking about absorption costing, remember, just takes all of the overheads, even if they're fixed, and apportions it to the individual units as well. That's not what we're talking about here for cost volume profit analysis. So 1 is not a suitable answer. Number 2, profits are calculated on a marginal costing basis. As discussed, yes, because break-even is taking into account what is fixed and what is variable. So by definition, marginal costing or our variable costs are part of these calculations. Number 3, it only applies where there is a constant sales mix. A constant sales mix means that you've got the same product range. So the products are very, very similar. And yes, this is the case. It's very difficult to work out a break-even calculation ratio or graph when you've got products that are all very different. So for example, where you're using job costing, you can't really use break-even analysis because each item is very, very different, and so it's not going to be suitable. So we do like number 3. Number 4, it only applies where there's a changing sales mix, is a direct contradiction to number 3. So for exactly the same reasons discussed, we can't use number 4. So we need to find an answer that has numbers 2 and 3, in other words, C. Cambridge, June 2016, paper 1-1, question 28. How is a margin of safety calculated? Remember that a margin of safety is talking about making an extra quantity of products over and above whatever your break-even point is. So if you would break even, for example, at a certain number of units, you want to make more than that so that you are making a profit. And the difference between your break-even point and the quantity that you are planning to produce will be your margin of safety. So how would you calculate this? It will be your actual sales minus the break-even sales. In other words, A is going to be your answer over here. B, actual sales minus budgeted sales, is simply telling you what your sales variance is if you're looking at budgeting. Number C, actual sales minus cost of sales, gives you your gross profit, so that's also not what we're looking for. And number D, budgeted sales minus cost of sales, assuming that it's minus budgeted cost of sales, would simply give you your budgeted gross profit. So all 3 of those are not relevant at all, and we would want to have A as our answer. Question 29. A company incurs total costs of $2,200 for producing 100 units and $4,600 for 300 units. The selling price per unit is $20. What is the total profit or loss at a production level of 200 units? Now over here, you're given a variety of information, and you're going to need to use break-even to help you here. Although you obviously don't have to draw up a graph, you can just do it using calculations. The graph might help you to understand better what exactly is going on here and why the calculations work, and that is why I have created a graph for you. So in this graph, what I've done is I have redrawn it based on, if we know that the total costs of 2,200 are at 100 units, that means that my orange line over here is going to be 2,200 at 100 units. And so I will plot the orange point over there, and then I would also plot the point of at 300 units it's going to be 4,600, so I plot that point. I can then draw a straight line through to join both of them, and will realize that it will go through 0 units at $1,000. That means that my fixed costs must be $1,000, because even if I am not making and selling anything, I have got 1,000 as my fixed cost. So that's how I will put the blue line in as well. So now I have created my total cost line and my fixed cost line. The fact that the selling price per unit is $20 means that I can factor in over here. Obviously, it would go through 0. I take any point, times it by $20. So, for example, if we use 300 times 20, it would be a revenue of 6,000, and I can draw that. And then I can actually read off immediately where my break even is, and I can work out my variable costs. Now, the easiest way of actually working out your variable costs is by simply looking at your variable over here between these 2 points. This area that is sitting underneath the orange graph here can be used because it's a constant slope. The gradient is going to stay the same, and it is at the ratio of the variable costs to the units. So therefore, what I'm going to do for my calculation is I'm simply going to take my two total costs of 4,600 minus 2,200 to work out what the variable cost changed by, and I will divide that by what the quantity changed by, the 300 minus the 100. And doing that, this is looking at this gradient over here between the 100 and 300 units at that point there, and I will find out that my variable cost is actually $12 per unit. Once I've identified that $12 per unit, I am therefore able to work out the fixed cost as $1,000, which is by saying the 2,200 at this point minus the variable costs, which is this part over here, and I'm then able to see that my fixed costs must be $1,000. Obviously, if you've drawn the graph, you'd be able to just read it off as $1,000. Once you've got that information, you're then able to work out what the profit or loss would be at this point of 200. Obviously, if you've drawn the graph, you could just read off the difference over here, which you can see is approximately 600, but it certainly is more accurate to do the calculation, because otherwise you might read it as 500 and you would be a little bit wrong. So rather do it as 200 units times $20 gives you 4,000 as your sales revenue at that point, minus obviously your fixed costs of $1,000 that you've worked out, minus this variable cost over here, which is going to be 200 units times the $12 variable cost per unit that we calculated, and we can then work out a profit of $600, which we can then see is going to be answer B. Let's now have a look at question 30. A company provides the following information in respect of its carriage costs. You can see that the units carried at 2,000, the total cost was $6,000, and if they carried 5,000 units, the total cost was $13,500. When 5,000 units are carried, the cost will increase the fixed charge by a further $2,000. So what will be the cost to carry 6,000 units? Now, over here, although we're referring to carriage costs rather than production costs, we can actually do a calculation that is exactly the same as this one over here that we used in the previous question. So our calculation method is going to be the same, and I'm sure you'll recognize it. Firstly, we would look at what is the variable cost per unit that is carried. And we'll do that by looking at the total change in the total cost. So the 13,500 minus the 6,000 to get a difference in the total cost, and divide that by the difference in the units carried. In other words, the 5,000 minus the 2,000. And we can then work out that the variable cost is $2.50 per unit that is carried. We can then figure out what the fixed cost is for 5,000 or less by saying, and you can actually do this for either quantity. You can either do it for the 6,000 or the 13,500. I always like to use it for the smaller number. It just makes more sense. But whichever one you use, you will get the same answer. In this case, let's take the 6,000 units, the 2,000 units at 6,000 cost, minus the variable cost that is associated with producing 2,000 units at $2.50 each, and you can then work out that in this case, it's also going to be $1,000. That is the fixed cost for a 5,000 units or less. We are then told that if we make more than 5,000 units, there is going to be an extra cost of $2,000, and therefore the fixed costs for more than 5,000 will actually be $3,000. So if you're then carrying 6,000 units, you're going to have a fixed cost of 3,000 that we've just worked out, plus a variable cost, which would be the 6,000 units times that $2.50, which is 15,000 total variable costs, and therefore your total carriage costs will suddenly jump to $18,000. So as you can see, you really do want to try and keep it under or produce or carry a whole lot more than just the 5,000 or 5,001. So we will over here choose C as the answer. Let's now have a look at the next question. Cambridge, November 2016, paper 1-2, question 26. A company makes and sells a single product for $12 per batch. The variable cost is $4 per batch. Fixed costs have been absorbed based on normal activity level of 1,000 batches at $3 per batch. What is the profit under marginal costing if the company makes and sells 1,500 batches? Now, if we are using marginal costing, it means that we are taking into account what our variable costs are, but notice that we have absorbed the fixed costs into the 1,000 batches over here, and we need to take that into account in the way that we are calculating it. So we know that the revenue will be 1,500 because it's asking about 1,500 batches. So 1,500 batches at a selling price of $12 is going to be 18,000 as our revenue. The fixed costs, if they were absorbed at a normal activity level of 1,000 as $3 per batch, that is telling us that the actual fixed cost is going to be $3,000. Now notice that what I've done over here is I've used the normal activity level to work out the actual fixed costs, because when I'm using marginal costing, I want to use my actual fixed cost. I'm not going to include that fixed cost as a cost per unit. I'm going to keep it on its own as total fixed costs. So work backwards from this information over here to see that the total actual fixed costs must be $3,000. The variable costs, however, I will again go back to the 1,500 that I am using for my budgeting. And over here, I know that the variable cost is $4 per batch, so therefore 1,500 at those $4 is going to be $6,000 as my variable costs. I can then work out the profit as my revenue 18,000 minus fixed costs of 3,000 minus 6,000 variable, which gives me a profit of $9,000, or C. Question 27. The following information was provided about a product. We are given the selling price per unit, the variable cost per unit, the total fixed costs, and the demand. Demand means that this is what people are willing to buy if that is the selling price. Now, we've also factored into this question, if the selling price increases, then the demand is going to change. So if we push that price up a little bit, the demand will go down. And the question then says, when the selling price increased by $4, in other words, from $50 to $54, the profit fell by $1,200. And therefore, what was the decrease in demand? In other words, we are being told that at a selling price of $54, we made $1,200 less profit. And we need to therefore know or work out what the quantity would have been at this point. So we're going to have to do quite an interesting calculation over here. We first need to work out at 1,800 units what the profit would actually have been. And you can work that out by obviously saying 1,800 times the selling price of $50 to get a revenue of $90,000 minus your variable costs, which is 1,800 units times the $26 variable that was given to you to get 46,800 minus the fixed costs of 10,000. So that is telling us that our profit at this point is $33,200. If we are then now going to have a look at a different quantity, what we can do is we can make the demand or the new quantity X at the increased selling price of $54 and then recreate this equation. We can say our new quantity X times $54 selling price minus the X times $26 variable costs, or if you wanted to, you could actually combine the two of them. To get your contribution margin, which would be 54 minus 26 times X, and then minus your 10,000 fixed costs, because obviously that won't change, is going to equal a smaller profit. In other words, the profit that we made at that 1,800 units minus the 1,200, because it tells us that the profit fell by 1,200. And then you can solve for X. If you solve for X, you will then be able to see that the quantity is going to be 1,500, or this is going to be the new demand. Now, careful, 1,500 is not yet your answer because the question was asking what is the decrease in demand. In other words, the difference between the 1,800 that you had and the 1,500 that is demanded now, which is a drop of 300 units. And so that is why your answer will be B. Excuse me. Question 29. A company makes a product for which the following information is given. Again, we are given the selling price per unit, and then we are also given direct materials and direct labor per unit. So these are our prime costs, our direct costs. Obviously, they are also variable. We are told that total fixed costs are $40,000 and planned production is 1,000 units. Which action should the company take to break even? Now, what we want to do over here is first work out what our break-even point is with these figures that we have, and we can work out that the break-even is going to be your fixed costs of 40,000 minus your 100 minus your direct costs of 40 and 30 gives you a contribution margin of 30. In other words, you would need to break even at 1,333 units. You can immediately see that if you're planning to produce at 1,000 units, you're going to make a loss, and so that is going to be rather problematic. If you want to break even, you would need to adjust your variable costs to, you can work it out by saying 40,000 is your fixed costs divided by your contribution margin, which is your selling price minus your variable costs, and which would then give you 1,000 units that you're hoping to make, which means that you want your variable costs to be 60. That means that the direct materials and the direct labor together need to equal 60, and at the moment they are 70. That means that either you need to drop your direct materials from 40 to 30, in other words, by 10, which is 25% of this, or you need to drop your direct labor from 30 to 20, in other words, by a third, or 33.33%. If you look at the options that are available to you, A might look like it's going to be right, but notice here that they are giving you an option of dropping by 30%. If you drop by 30%, you're not quite going to get to the amount that you need. You're actually going to get about 21, and that's not going to solve your problem. So in fact, B is going to be the option you need. Both C and D suggests that you increase the price, and obviously if you increase your costs over here, your labor and material costs, that would just increase your break-even point, and that would not help. Let's look at Cambridge, June 2016, paper 1-2, question 26. Why might a business use marginal costing? To calculate break-even units? Absolutely. We've already seen in previous questions that there is a link between our break-even or cost volume profit analysis and our marginal costing, because marginal costing is separating our fixed and our variable costs, which are needed to calculate your break-even point. Number 2, to decide on the most profitable use of limited resources. Yes, we can certainly use marginal costing over here because it helps us to look at the different alternatives and compare them. And lastly, can we use marginal costing to decide whether to make a product or buy it? Absolutely, because it helps to identify the profits that you would make or the total costs at different levels. So in fact, you're going to choose B. All 3 of these options will be suitable. Question 27. A business provided the following information for the past 2 months. You are told that the number of labor hours for February was 64,000 and the total overheads 918,000, March 76,000 and total overheads 1062,000. As you can see over here, they are comparing the total overheads to the number of labor hours. And as you can see, there is definitely a variable component because the more labor hours that are worked, the greater the overheads. What was the monthly fixed overhead cost? So what we need to do now is look at this and try and take out the variable component to work out the fixed part of it. This is going to be very similar to a number of the other previous questions that we've done, but in this case, instead of using the number of units, we are using the number of labor hours. So firstly, we will look at the difference between our total overheads and say the difference between the 1062 and the 918,000 to get 144,000 as the variance in total overheads. And then look at the variance in the number of labor hours. In other words, 76 minus 64,000, which gives you 12,000. If you divide, you can then see that the variable cost is going to be $12 per labor hour. The fixed overheads can then be calculated by taking either one of these amounts and then just using the correct number of labor hours. For illustration, I've used the 918,000 as the total overheads, and then subtract the variable portion, which must be the 64,000 labor hours times the $12 per hour that we've worked out to get 768,000. And the difference, therefore, between the total cost and the variable cost is going to be the fixed overheads of 150,000, or B. Let's look at question 28. A company uses marginal costing. Which costs are included in its inventory valuation? Now, again, if we're looking at marginal costing, remember that it means we're using all our variable manufacturing costs. We are only using manufacturing costs over here, so anything with the fixed manufacturing overheads needs to be excluded. And obviously selling expenses also is going to be, so that's why I'm going to take the selling expenses out because it's not manufacturing, and I'm going to exclude A and B also because fixed costs don't come into it. Remember that marginal costing is referring to variable costs. So therefore, the variable manufacturing cost only, or D, is going to be the most suitable answer. Question 29. Above the break-even point are sold. Well, what you need to do over here is take into account all of this information and recreate what is missing. The first thing is we know that it's at a break-even point of 1,000 units. So from that, we can then work out what the revenue is at 1,000 units. At 1,000 units, the revenue is going to be $30,000 plus $20,000, because obviously at break even there's no profit and no loss, and so therefore your total sales or revenue equals your total costs, or variable plus fixed. So we can then work out that the revenue at 1,000 units is $50,000. We can then work out that the contribution margin, or how much each particular unit actually contributes towards covering your costs, is going to be your selling price per unit. In other words, 50,000 divided by the 1,000 units is $50, minus the variable cost per unit, or the $30,000 total that was given divided by the 1,000 units of $30, which gives us an answer of $20 as the contribution margin, or how much each particular unit will actually contribute towards covering the costs. Now, if there are 70 units over and above break-even point, that means that instead of breaking even and our revenues just covering costs, it means that every unit above that point that is actually made, that contribution no longer needs to cover the costs and is able to contribute towards the profit instead. So the profit will be exactly that extra 70 units times the contribution margin of 20 that we've just worked out, which is going to be $1,400 profit, or B.